Hey everybody, Rebecca back for the next episode of our Monday Mr. Money Mustache Motivation. If you're new to me and my channel, welcome. I'm here on YouTube showing you my journey to financial independence, and on Mondays I reserve this day to read a blog post from the Mr. Money Mustache website. He is probably the most well-known financial independence retire early blogger. And just as an aside, as a quick follow-up from my last video, it's been a few days. Feeling a little bit better, feeling a lot better actually now that I was able to wash my hair, which is why it's so poofy, but I did not bother to fix it for this video because I'm still quite sore, still recovering from the surgery, but it is what it is. At least I'm feeling better than I was in the last video. So if you have not yet, subscribe down below. I checked this morning and at the time I'm recording this, I have less than 10 subscribers to go before my channel is eligible to be monetized, which is really super exciting. So we'll jump into this episode. Today is coming from January 2nd, 2012. This blog post is titled Guest Posting, the Dividend Aristocrats. So we are continuing on with our dividend discussion on the Mr. Money Mustache website. We'll kick off the new year with some more advanced study. Here is another angle on dividend stock investing from another guest author, Sean Owen. Sean is an engineer, lawyer, and writer. His articles on investing and finance have been featured by Forbes, the Huffington Post, and Seeking Alpha, among others. He blogs about financial independence and sustainable living at renewablewealth.com. So, along with the link to this blog post down below, I will put a link to his blog as well, since he's the guest writer on today's blog post. The Aristocrats. Now you've had an introduction to the wonderful world of dividend investing, you might ask yourself, what could be better than a company that pays you every quarter for the privilege of having you as a shareholder? How about a company that gives you a raise every year? It turns out there are a number of companies out there with a proven track record of doing exactly that, and there's an easy way to find them. Enter the Aristocrats. The S&P Dividend Aristocrats is an index company that consists of companies that have raised their dividends every year for at least 25 years in a row. This is an elite club indeed, because if a company ever misses a single dividend payment or ever fails to give investors a raise, then it's booted out and must start that 25-year clock all over again if it wants to get back in. The index currently includes many familiar companies like Johnson & Johnson, McDonald's, and Walmart. But there are others on the list that aren't necessarily household names. Companies like Abbott Labs, Dover Corp may not make many headlines, but they have also paid increasing dividends for 25 years or more. That period includes several nasty recessions, including the most recent one, which is the worst since the Great Depression. The share prices of these companies may have fluctuated during these rough patches, but they kept raising their dividends relentlessly through it all. Boring is best. Many people think of these sorts of stocks as boring. Traders often deride them as being for widows and orphans. Many will tell you that a company that has paid increasing dividends for 25 years is too big to grow. My response to that is, as my dad would say, horse hockey. The Dividend Aristocrats have outperformed the S&P 500 over the previous 5, 10, and 20-year periods, quite handily in fact. Did not actually know that myself. Here's another way to look at it. A company that pays steadily rising dividends is a company that makes so much money year after year that it simply can't use it all, and they believe the best use of all that extra cash is to reward their shareholders. That sounds like a company I want to own. An example from Warren Buffett. For a great illustration of the amazing power of dividend growth investment in general, and Dividend Aristocrats in particular, we need to look no further than the world's greatest investor. Warren Buffett established a position in Dividend Aristocrat Coca-Cola in 1994. Check out his comments on that investment from a letter to Berkshire Hathaway shareholders. Quote, Coca-Cola paid us $88 million in 1995, the year after we finished purchasing the stock. Every year since, Coke has increased its dividend. In 2011, we will almost certainly receive $376 million from Coke, up $24 million from last year. Within 10 years, I would expect that $376 million to double. By the end of that period, I wouldn't be surprised to see our share of Coke's annual earnings exceed 100% of what we paid for the investment. Time is the friend of the wonderful business." End quote. You read that right. By 2021, if Coca-Cola stays on its current trajectory, the shares Buffett bought will earn more in dividends alone every year than his entire investment back in 1994. How's that for boring? Wow, we'll have to revisit this and see if that's true or not come next year. My shares have gone down. Awesome. There's a sort of magic in investing with companies like these. When you stay focused on collecting your paychecks from the companies you own rather than the share price, you can ignore the wild fluctuations in the stock market that keep less enlightened investors awake at night. You can simply sit back and collect ever-increasing income from your portfolio. In fact, if you reinvest your dividends, which I highly recommend you do, you might just learn to love it when your favorite company's shares go down. How can that be? Because those reinvested dividends will buy you more shares when the price is low, which will in turn earn even more dividends in the years to come. Y'all think about that for a second. That's some powerful snowball effect right there. And he's got a point. And I know a lot of you dividend investors out there right now are taking a look at this little market downturn and seeing what is on sale and planning out what shares you want to buy next. Investing in the aristocrats. So what's the best way to invest in the Dividend Aristocrats? One simple way is the SPDR and S&P Dividend ETF SDY. This is an exchange-traded fund that tracks the S&P High Yield Dividend Aristocrats Index. This is a slightly different index, which includes Dividend Aristocrats from the S&P 1500 rather than just the S&P 500, but it has the same 25-year dividend growth requirement. It has reasonably low expenses and currently sports a very respectable 3.3% dividend yield. If you don't want to put a whole lot of time in learning how to evaluate individual stocks, you could very well just stop here. The holdings in SDY are quite well diversified and represent many of the most rock-solid companies across a wide variety of sectors. It's a portfolio that will help you sleep well at night, whichever way the market is moving. An elite cheat sheet. If you prefer to pick your own stocks, whether you're a seasoned pro or just starting out, there are no shortcuts. Doing your homework on each and every stock you consider for investment is absolutely essential to your success. It can be a daunting task when you have thousands of stocks to choose from. The 2012 High Yield Dividend Aristocrat Index only has 61 companies on it though. If you narrow your search to these, doing your due diligence suddenly feels a lot more doable. In fact, it's perfectly feasible to do a thorough analysis on each and every company on the list, and that's precisely what I recommend you do before investing a dime, especially if you are new to investing. For a great primer on valuing stocks, check out The Intelligent Investor by Warren Buffett's mentor, Benjamin Graham. Read it and then get to work combining the aristocrats for bargains. It will be time well spent. You'll be a much better investor when it's done, and you will have an opportunity to practice the #1 most important skill for any investor to have: patience. All right, y'all, so one of you had pointed out in the last episode of the Mr. Money Mustache motivation that I do that the guest posting he had on then did not mention dividend ETFs, and you are correct. So I'm glad that they brought it up in this one. So I personally use M1 Finance to invest. Referral link is down below. If you are interested in getting started with them, they are awesome. So there's a lot of things I like about them. One of them being their automatic drip. They will automatically reinvest your dividends for you. And they do have fractional shares, which means you don't have to have the entire value of some company's share in order to buy in. If you've only got 50 bucks to invest, you can throw 50 bucks at whatever company you want to invest in. They do also have ETFs on their site. One of the dividend ETFs that I really liked the sound of was the high yield, low volatility dividend ETF. The ticker symbol is SPHD. You can look them up if you would like. So what I did for them was go through the list of companies that was in SPHD and pick out the ones who were at least Dividend Aristocrats, and who also paid qualified dividends. Now, the yield on the SPHD is a little bit higher because they do have some REIT companies inside of SPHD, and REITs are unqualified dividends, so basically they get taxed at a higher rate. So to get around that, I just took a look at all the companies in the SPHD, and I picked out the ones who were at least Dividends Aristocrats and who were also qualified dividend payers. I took those companies, it ended up being 40 or 45 of them, I think, and I made my own little investing dividend pie out of those companies. I really need to do a portfolio update. Maybe I will get that filmed later this week and I can show you the individual companies that I have picked. I've done a little cleaning up on my M1 taxable account. I used to have just all of these dividend paying stocks grouped together. I have since broken them out into pies within pies, which sounds a little complicated, but it's really not too hard to do with M1. Basically, I just separated the companies out into their own individual sectors within my dividend slice of pie on M1 Finance. So that way, when the market does take a downturn, I can look and see which sector is doing the worst, and therefore, if I want to put more money into my dividends, then I can buy the sector that's struggling the most and maybe the share prices have dropped the most, so that way I can get the best deal when I put more money into the pie. So basically I just reorganized it and created my own version of the SPHD. There's probably a couple of dividend payers in there that aren't aristocrats. I know I did add Disney in there just because I really like Disney, so I wanted to have them in my pie as well. And as a side note, I do invest in REITs, and I love the fact that REITs have a high dividend yield. They pay really well if you would like to invest in REITs. And again, I wasn't too keen on picking out individual REIT stocks to own. When it comes right down to it, I'm a fairly lazy investor when it comes to scale of people investing out there, and I like to keep it pretty passive. So what I did there, again, was choose a REIT ETF, and the one that I went with was Vanguard. I love Vanguard's ETFs. Their expense ratios are low. So yeah, I chose their REIT ETF. The ticker symbol is VNQ. And since REIT payouts are unqualified dividends and are taxed at a higher rate, to get around that, I put my VNQ inside of my Roth IRA. So now all of my dividend payouts from VNQ are tax-free, and they are growing tax-free as well. Pro tip. Just kidding, I am not a pro when it comes to investing. And on that note, do not take this as investing advice at all. I'm just telling y'all what I'm doing as a new investor and learning along the way. I have no financial credentials whatsoever. I'm just out here working a W-2 job like the rest of you, trying to build a little wealth for my future. So everything you see on my channel is for entertainment purposes only. Y'all do your own research and figure out how you would like to invest. I guarantee you it'll end up being a little bit different than how I like to do it. We're all individuals and everybody has their own style of investing that they enjoy doing, and that's the way it should be. Also, over time, my investing strategy can and probably will change as our needs change as individuals. So it's an exciting ride. If you would like to follow me for my investment journey and see how I'm going to reach financial independence, again, scroll down, click that subscribe button, and I'll see y'all for my next video. Thanks for watching. Bye.